as you all know, yesterday we got introduced to Dr. Gupta. We know about his credentials, his achievements, and his capability. And you had a glimpse of how interesting such lectures are. So, sir, today I'm not going into the formal
No, no,
introduction.
not required, sir. Not required, sir.
Used to
Thank
it.
you.
Exactly.
Thank
And
you. Let me share
your
my presentation, sir. Just a
your
second.
performance speak louder than the words, sir. Or as loud as the words, I would say, if not. So with this, we invite Professor Dr. Gupta to go ahead with the presentation. And honestly, we all are looking forward to this interesting
Thank you,
topic
sir. Thank
on
you.
valuation of companies in the maturity phase. Sir,
Thank
over
you.
to you. Yeah.
Thank you. Good morning and welcome to all the participants of this FDP.
Good
Good morning,
afternoon, sir.
madam. Good morning, sir. In this session, I'm going to talk about how to value companies and especially how to value companies which are in the maturity phase. So essentially, it's going to be a session on valuation, understanding what is valuation, understanding what goes behind valuation, and then coming down to valuation of companies, and then valuation of companies in maturity phase. That means you got to understand what are the attributes, what are the characteristics of companies which get into the maturity phase so that we can make those adjustments either in the premium or on the discount side for coming out with relevant valuation for companies in a maturity phase. So that's going to be the broader framework of my session. We would all tend to agree that the world is changing and it's a VUCA world which is highly vulnerable, very uncertain, hugely complex, and very ambiguous. And this has given rise to very, very disruptive business models in a marketplace. We have the world's largest travel car company, which does not own a single car of its own. That's Uber. The world's largest travel lodging company does not own a single hotel room of their own, Airbnb. And the world's largest retailer, Amazon, does not have a single brick and mortar store. These are very, very disruptive business models, which are kind of unheard of till about a few years ago. But these are the realities of today. The new age companies, startups, these are the kind of innovative models that they are coming out with. We have a company in China which has come out with the novel idea of selling fresh, pure air filled up in canisters, which they have brought from Alps Mountain, Switzerland. Now, somebody might say, how can you sell air? Who will buy fresh air? But then, air is freely available on the planet, yes, but most parts of the world today are polluted to a lesser or a greater degree. People are craving for getting fresh, pure air, a breath of fresh, pure air. And that's what the Chinese company has hit on that particular idea. They have gone to the Alps Mountain, Switzerland. They filled up canisters of fresh air and they are selling it like water bottles in Western market. Probably the product hasn't yet arrived in the Indian market, but it's definitely selling out there because of being a very, very novel idea. Now, when you look at performance of many of these new age companies, we find that many companies have profitless turnover. They might have a good enough top line, but end of the day, there is no profit. Or they have cashless profit. They have a good enough bottom line, but end of the day, there's no cash, there's no liquidity. Profitless turnover, cashless profit, but when you look at their valuations, wow, skyrocketing, soaring very, very high. The point is, in today's business world, profit and profitability have kind of lost their relevance, at least to the extent of being the prime objective of any particular business. Profit is important. Otherwise, you can't sustain on a long term basis. But profit is not the sole objective. Profit is not the core focus. Today, the success mantra for a company in 21st century is value. Creating value for the stakeholders, preserving that value for the stakeholders, and enhancing the value of the enterprise going forward on a sustainable basis is the success mantra for any company today in 21st century. Creating value, preserving value, enhancing value. And that's what we're going to talk about. What valuation is all about. How do we actually look at how much valuable a particular company is? What are the dimensions and factors of valuation? And then going to understand what are the specific attributes of companies which are in the maturity stage. That's going to be the focus of today's session. So I think it's a trilogy of price, cost, and value. What is price? What is cost? And then what is value? Value lies in the eyes of the beholder. That is why valuation is highly subjective. It's more of an art rather than a science. It's actually a craft. You can't simply look at the numbers and weave out a craft out a number that this is the valuation of a company. It involves judgment. It involves hunch. It involves estimation. It involves gut feeling. And your experience will help you a lot in arriving at a fairly reasonable, acceptable value for any business. Value lies in the eye of the beholder. Same thing can carry different valuation from the perspective of different persons. I'm reminded of a small story out here. There was an old person on his deathbed. He had some serious illness and he had just a few hours, maybe just a few minutes with him. And his mature grown-up son was standing beside him. And his last gift, as the last parting gift, this man took out his wristwatch and gave it to his mature son and said, "My dear son, my time has come. I'm going to die any moment. This is my last gift to you. This will help you out in case of your difficult times in your life." And after some time, that old man passed away. This young fellow, over 35, 40 at that point of time, was doing pretty well in his life. And he had almost forgotten about this wristwatch. But then there is a life cycle that all of us have. Nothing remains the same. We all have good times. We all have bad times. And there is a cycle that's there as part of the nature. And this fellow also faced some kind of a challenging times in his life, maybe about 25 years later. He suddenly thought, that wristwatch which my father had given to me, let me take it out and find out how is it going to solve the current financial problem that I'm facing in my life. He took out that watch and went to a watch repairer shop and asked him, how much money would you pay me for this watch? And that fellow said, this is a useless old watch. I'll pay you 500 rupees for that. He was devastated. My father said, this is going to help you in your financial times. But look here, I'm getting 500 rupees for this watch. He talked to one of his friends, and his friend suggested, this is a UK manufactured watch. Why don't you get in touch with the company which manufactured this watch maybe about 100 years back? Probably they would be able to offer you a better price for this. He contacted the company, and the company promptly responded back saying that we have since discontinued production of this particular model of the wristwatch, but because you are our old customer, we'll be pleased to offer you an amount of 5,000 rupees. He was again very, very dejected. Just about 5,000. My father said, this is going to help you out in your life. Then after a few days, one of his friends suggested, why don't you go to a city museum? Talk to the administrator there, talk to the curator of the museum. Maybe he'll be able to offer you a better price. Next day, he went to that museum, and after seeing the watch, the curator of the museum, the owner of the museum, immediately offered him such a unique piece, such a masterpiece. It will be a very, very good addition to my museum. And he offered him immediately an amount of rupees 10 lakhs for that watch. Value is in the eye of the beholder. Same watch, 500 offer, 5,000 rupees at offer, 10 lakh rupees offer. It depends upon what is the value of a particular business, of a particular company, of a particular asset in the eyes of a particular buyer. That's what ultimately matters in valuation. Therefore, value is in the eyes of the buyer. Value is the function of future benefits. If you decide to pick up a stock at 1,000 rupees today from the stock market, which has moved from 800 to 1,000 in the period of last about 4 months, it has been a great performance of the stock in the period of last 4 months, moving from 800 to 1,000. But you have not been a party to that celebration because you are picking up the stock today at 1,000 rupees. And why are you picking up at 1,000 rupees today? Because you expect the stock price to move still further. You expect the price to go up still further. That's why you are picking it up at 1,000 rupees. So value is all about estimated, expected, potential, future benefits likely to arise or accrue from an asset that a buyer purchases at a given point of time. Of course, cost is important for the seller. Anyone selling a product would not sell it at less than the cost of acquisition or cost of manufacture. We have a concept of predatory pricing in management accounting, yes, which says that many a time and sometimes a manufacturer might also decide to sell his product at less than the cost of production with a view to killing competition out. Of course, that concept is there, but normally nobody would like to sell his product at a cost less than the manufacturing cost or less than the cost of acquisition. So, from the seller's perspective, that becomes kind of a base price. This is what I must get. If I'm selling a particular product, this is what I must get. Because for the creation of this particular product or for having this particular asset, I've already incurred a certain cost. I must be able to realize that cost. If not a top of margin, at least that cost must be realized. Then we come to price. Price is what you pay, value is what you get. Price is what you pay, value is what you get. When you go to a market to buy a shirt, you have a choice. You would like to buy a branded shirt or an unbranded shirt. A branded shirt, Louis Phillips, Van Heusen, costly, but stitching would be very, very good. Cloth would be very, very good. Designing latest, and it's going to last you quite a while. If you look for a local shirt, the cost will be less. Design may not be all that very modern. Stitching may not be all that very good. Cloth also may be just ordinary. You have a choice. What price you would like to pay and what is the value of that product in your mind. You always got to balance price with value. An appropriate deal or a reasonably good deal for a buyer is where the price is commensurate with the value that you expect to derive from a product which you are buying at a given particular price in the market. Price is what you pay, value is what you get. I remember the case study of Tata Chorus at this point of time here in terms of price and value. Tata Steel is a very big company of India, employing huge number of employees, has a huge turnover, has a huge capacity, very, very big company of India. But Tata Steel was toying up with the idea of, and they were scouting around for an acquisition of a company in Europe because they wanted to have their footprints in Europe also. This was in the year 2006. Finally, after scouting around for about 6-8 months, they identified and zeroed in on Chorus Steel of UK. Tata Steel is a very big company of India, but Chorus Steel was at that point of time 4 times bigger than that of Tata Steel. 4 times bigger than that of Tata Steel. This was actually a case of reverse merger. Normally, what do we expect? A larger company acquiring a smaller company, but when it happens that a smaller company acquires a larger company, it's a case of a reverse merger. And the deal was almost finalized. They were going to buy out all the shareholding of Coro Steel Limited at the price of 4.5 pence per share. Pound and then pence per share. The deal was almost done. The deal was not negotiated by Mr. Ratan Tata. The deal was negotiated by one master negotiator of the Tata Group, Mr. Gandhi, Mr. M.R. Gandhi. He was there sitting in London, of course, on a hotline. He was in direct touch with Mr. Ratan Tata, who was sitting in Tata House, Mumbai. But the master negotiator, the front end negotiator for Tata Group was Mr. Gandhi. And the deal was almost done. Suddenly, what happened? A Brazilian company jumped into the fray. They offered a higher price for acquiring the shares of Coro Steel. The Tatas also increased their bid. The Brazilian company once again raised their bid. The Tatas were finally able to seal the deal, able to close the deal at 30% higher price at which they had originally bid for acquiring the shares of Coro Steel Limited. That was in 2006-2007. What happened thereafter? The valuation of Tata Steel has never really looked up ever after they picked up Coro Steel of UK, because the price that they ended up paying was higher than what should have been the normal price for acquiring Corus. Had they got it at 4.5 pence per share, it would have been a really good deal, but they ended up paying 30% higher because of the entry of a competitor in between, and that's what killed the entire value out of Coro Steel Limited. Now, Tata people are trying to sell it out, but the company is such a huge company, they are not able to find one single buyer, one single company, one single owner trying to buy out the entire Coro Steel. Now, what they have decided is to sell it in parts. They're going to divide the company into divisions, they're going to divide the company into segments, and they will try and sell it out segment wise. But this was a wrong decision on the part of Tata at that point of time, because the price that they ended up paying for Coro Steel was not commensurate with the value that they were expecting to derive by acquiring Coro. So price, how is the price determined in a valuation deal or in any transaction? It is determined on the basis of negotiations. When you go to a market, you buy any product, and the seller says 100 rupees, we don't take out our wallet and straight away pay 100 rupees for that. No, we don't do that. We always try to haggle. We always try to bargain, negotiate. Oh no, Baba, 100 rupees too much. I think 80 should be fine. It all depends upon the relative bargaining powers of buyer and seller as to where the price is ultimately going to be struck. It might be at 100 rupees if the seller is in a very strong bargaining position, or the price of the deal might be somewhere in between at 90, 95, depending upon relative bargaining powers of the buyer and the seller. So, valuation is a challenge of integrating value, price, and cost. The seller would not budge. He would not like to sell a product or an asset at even the less cost than the cost of acquisition or the cost of manufacture. The pricing thereafter is getting decided by the negotiation between the two parties, and the price that the seller would be willing to pay, will be willing to offer for a particular asset, will also depend upon what is the commensurate value that he expects to derive by acquiring this asset at this point of time. So valuation is all about, and it's actually a challenge of integrating value, price, and cost. Value also depends upon three factors. Who is doing valuation? Who is doing valuation? That means if the valuation is being done by the buyer, or the valuation of a company is getting done by the seller, or the valuation is being done for a legal purpose. It all depends who is doing valuation. If the valuation is getting done by a registered valuer, the concept under section 247 of the Companies Act 2013, which says that all valuations under various provisions of the Companies Act 2013, or Insolvency and Bankruptcy Code 2016 are required to be done only by a registered valuer. Who can be a registered valuer? A person who has at least 5 years experience and who is a professional. Postgraduate in commerce, a cost accountant, chartered accountant, company secretary, MBA finance. And then you have to also pass an examination being conducted by Insolvency and Bankruptcy Board of India. As of today, there are 4,400 registered valuers in the marketplace. And you have different classes of assets for which you can become a registered valuer. The three asset classes mandated under the law are securities of financial assets is one, plant and machinery is second, and land and building is third. So there are 4,400 registered valuers in the marketplace as of now, comprising of members of all the three asset classes. Of course, the maximum number of valuers that we have in the marketplace are for the securities and financial assets category, followed by land and building, and very few from the plant and machinery asset class. Value also depends on why valuation. Valuation is required for various purposes. If you have a joint Hindu family and there is a division of the family property, valuation might be required. If you have a partnership firm and the partnership firm is getting dissolved or a new partner is getting entered, again you have to have valuation. In case of a mergers and acquisition, valuation is required. When a company wants to issue ESOPs, employee stock options, valuation is required. Valuation is required under Ind AS and also for finding out the fair value of shares and also for finding out impairment of assets. Third important aspect is value depends on the timing. When is the value being calculated? When is the valuation being carried out? If you look at the valuation of any company today and compare that with the valuation of the same company maybe in 2018, it's going to be significantly different, either on the upside or on the downside, depending upon what has been the impact of COVID-19 pandemic on that particular sector, on that particular industry, or that particular company. But the valuation definitely is going to be hugely different from what it was in 2018. Therefore, timing is very important. When you are looking at the value of a business, what is the time when you're looking at calculating value for any asset is the crux. So value depends upon who is doing valuation, what is the purpose, objective of carrying out valuation, and third is the timing when valuation actually is being carried out. Valuation is all a matter of hope because you're looking at future estimated benefits. If you are going to value a mature company and you're looking at the future, we have a life cycle of a company starting with innovation, growth, maturity, saturation, decline. You know what is the next phase? You know it's going to be a decline phase. Of course, in the marketing books you will follow, or in the corporate strategy books, there is a concept of second hump. That means instead of getting into a decline straight away after saturation or maturity, the companies try to come out with a different product profile. They restructured their company in a major way, and thus they try to prevent the decline at least for some period of time. But that might not be possible for all companies. Actually, valuation is looking at the future, and future is uncertain. It's all a matter of hope. You're going to pay a particular price for a product which you are buying today. You decide to pay a particular price for a company that you are acquiring today. And how is it going to fan out in future? What kind of uncertainty, what kind of impacts it is likely to have in the marketplace? Nobody really knows for sure. You have to forecast. You have to estimate. You have to guesstimate. You have to use your judgment, your gut feeling, your hunch. That's how you try to arrive at your valuation number. It might turn out to be good. It might turn out to be bad. But then that's a hindsight. You got to base your decision and you got to take your decision based upon whatever best data you have today, whatever best possible information that you have today. Based upon that, you have to take that decision. But nonetheless, valuation remains a matter of hope. And as we were talking yesterday also, valuation is not about only numbers. Numbers are important. The whole focus of business valuation is look for the right numbers. But the numbers are never a whole story. They are only a starting point. By looking at the past historical performance of a company, by looking at past trends, by looking at future estimation, you get foothold and try and understand what the business model is and how the business is likely to play out in future. But then using those numbers of the past and future, you have to weave and craft a story, a credible story, a realistic story, achievable story. And if you are able to successfully do that, that's how you can have a lot of value in the marketplace. But if your story is not credible enough, howsoever good your numbers might be, but if your story is not credible enough, I think it's not going to cut much of an ice with the buyers. They're not going to pay you a good price for that because your story is not credible. Story is more important than numbers. But story without numbers, it will not work. Numbers without story, that's also not feasible. There has to be compatibility between the numbers and the story that you craft out of those numbers. So initially, we discuss about approaches to valuation, whether we are looking at valuation of a mature company or a young startup company or a company in a growth phase. Basic approaches would remain the same. We have income approach, we have market approach, and we have cost approach. Under the income-based approach, the methods that are applied for valuation are discounted cash flow method or the price earning capacity value method. Under the DCF approach, the future free cash flows of the business are discounted to a valuation date to arrive at the present value of the cash flows of the business or capitalized using a discount rate depending on the capital structure of the company. The concept is first we got to look at free cash flows, future free cash flows. Free cash flow FCF is different from CF. Free cash flows are based on the basic accounting assumption of going concern. That once a business is established, it is likely to continue in the market for an indefinite period of time. That's the basic accounting assumption and concept on the basis of which entire accounting is done. And if you want to maintain and if you want to have continuity in your business on a going concern basis, that means you got to take care of frequent, regular, periodical maintenance charge, maintenance expenses of your plant and machinery, land and building, things like that. Unless you incur those kind of maintenance charges or maintenance expenses, it will be difficult for you to be able to sustain on an indefinite basis as a going concern. Thus, from the cash flow, we subtract maintenance charge, the fixed capital charge, which must be incurred with a view to maintaining continuity of the business. What is left is called the free cash flow. So we arrive at the free cash flow of the business over the next 5 years, 7 years, whatever time period we are able to forecast, and then discount that free cash flow at an appropriate discount rate. And that's a challenge. In any valuation exercise, how do we determine, how do we decide what is going to be an appropriate discount factor? So what are the factors on which, or what are the considerations on which the choice of a discount factor depends? First, normally we look at WACC, weighted average cost of funds, because broadly there are two different sources of funds. We have debt capital and we have equity capital. Within debt and equity capital, we have different instruments by which the money can be raised, and then that gets classified under debt and equity capital. Each different source of fund in debt capital and equity capital classification is going to have a different cost associated with each. And then simply by applying the concept of weighted average, we can find out one single number which will reflect the overall average cost of funds deployed in the business. That's the WAC. Second is we also got to look at inflation. What is the level of inflation prevailing in the market? Because that's going to impact the concept of time value of money, the expectations that you have regarding future free cash flows, how they are going to generate real value for you is all dependent upon what kind of inflationary trends we are expecting to have in the marketplace going forward. And therefore, it becomes important to look at the inflation numbers, not only in the past, not only the trend, but also more importantly, what are the inflation numbers likely to be going forward? CPI, WPI, Consumer Price Index, Wholesale Price Index. Third factor that you look at while choosing an appropriate discount factor is the riskiness of the project. Higher the risk, higher should be the discount factor to be used. How do we measure the risk? There are techniques available for measuring of the risk. We can calculate standard deviation. We can calculate coefficient of variation. You can also look at sensitivity analysis. You can also calculate certainty equivalent coefficient. There are various techniques by which we can work out the risk involved in a particular project. And the fourth factor, which goes into the working out of the appropriate discount factor, is the experience and judgment of the decision maker. Very important. You look at WAC, you look at inflation, look at riskiness of the project, but end of the day, it's a call which has to be taken by the decision maker, by the CFO, by the manager, and that's going to be based upon his experience and judgment. In one of my previous companies, we were looking at working out feasibility for a project, and we were going to use the discounted cash flow techniques. We had done a lot of research over the period of 2 weeks. I had a young MBA finance guy working as assistant to me, and he was doing a good job. He collected all the relevant information. We looked at WAC, we looked at risk, we looked at sensitivity analysis, we looked at inflation data, and it was almost about 2 weeks that we were working on this project. One fine evening, because I had to close it. You can't keep on just looking at different numbers every day. You got to close a project at some point of time. So I decided one fine evening, after looking at all the data which had been collected over the period of last about 2 weeks, I decided and told him, Beta, let's use 12.5% discount rate. Please work out the cash flow projections based upon this number and discount at this number. And tomorrow morning, 11 o'clock, show me the result, show me the data. He said, yes, sir. Next day, tomorrow morning, 11 o'clock, he was right there in my cabin with all the data nicely done. And the project seemed to be fairly okay, fairly feasible. It was meeting the target rate of return, which my management had told me to must have out of a project. And he was very happy. I was pretty happy. I said, let me go and talk to my managing director. And he immediately approved it. And he said, let's take the proposal to the board, the meeting of the board of directors, and then get ahead with the project. I came back to my cabin. I thanked that young man profusely. Thank you so very much for doing such a great job and doing it so very effectively, the calculations part. I'm so happy. All the best. He left the cabin very, very happily. But when it was 6 o'clock in the evening, the time when all of us used to leave the office, he once again knocked on my cabin and he said, sir, can I come in? I said, why not? He said, sir, I want to talk to you for 2 minutes. I said, please sit down. You are welcome. He said, sir, I have 2 questions to ask from you. I said, well, go ahead. He said, my first question is, after looking at the myriad of data that we had collected, we looked at WAC, we looked at inflation, we looked at risk, we looked at sensitivity. How did you decide to go for 12.5% discount factor? And his second question was, okay, whatever might have been your basis of choosing 12.5, but my second question is, why not 12.4% Or why not 12.6%? Why particularly 12.5%? He posed these two questions to me. To the first question, I said, what are the factors for determination of discount factor? WAC, inflation, risk, experience, judgment. I said, beta, I've done quite a few projects in my past innings in the corporate sector. I've seen some successes, some failures. And this is what experience has told me, that by looking at entire data which was made available by you to me, I somehow felt that 12.5 is going to work well, and it's going to give the target ROI that my management also expects. And that's why I decided to go for 12.5 based upon my judgment, based upon my gut feeling, based upon my hunch, based upon my experience. And to the second question, I said, even I don't have an answer to that. Maybe it is just on account of basic human psychology of tendency to center around the round numbers. 12.4 would not have made much of a difference. 12.6 would not have made any kind of difference. But 12.5, because normally we human beings tend to go for the round numbers. To the extent it is allowable and to the extent it is feasible, I said, I could have chosen 12.4, I could have gone in for 12.6, but normally human beings have a tendency of centering around the round numbers, and that was the reason, psychological reason, why I decided to go for 12.5%. So this is a very critical aspect of entire valuation exercise. How do you determine your discount factor and how appropriately that's been arrived at? Under PECV, price earning capacity value method, the average earnings on the basis of past 3-5 years are determined. Adjustments are made for exceptional transactions or items of non-recurring nature, and adjusted average earnings are then capitalized at an appropriate rate to arrive at the value for business. You have to arrive at normalized earnings. You look at your 3-5 years past data. If there have been some exceptional items of non-recurring nature, either on the revenue side or on the expenses side, you're going to take them out, normalize your data, and then apply a capitalization rate to arrive at the value for business by using PECV, price earning capacity value. Market approaches. If the company that you are valuing in a mature phase happens to be a company which is a listed company, then quoted market price, which reflects collective wisdom of large number of investors in a marketplace, can provide you a good indication or at least a good foothold, a starting point for arriving at the valuation of a company. A company might be overvalued at a given point of time or undervalued because market doesn't have a direct correlation with your performance. There are speculators, there are hedgers, there are arbitrageurs, there are a whole lot of other players in the marketplace which tend to distort the equation between performance and the market value of a stock. But then, if it's a company in the growth phase, which is a publicly traded company, you can compare the company's market cap with that of the peer group and then try and find out what is the appropriate multiple to be used or multiple to be applied with a view to arriving at value of a given subject company. And for using the multiple, you can have very many different bases. You can have enterprise value divided by sales. You can look at enterprise value by EBITDA. You can look at price divided by book value. You can look at PE multiple, or you can look at price of recent investment, PORI. All these techniques can be used depending upon the suitability of a particular approach in a given instance. Asset-based approach, the basic concept here is you got to look at the cost to build or the replacement value of an asset. If you are buying a house property, you're buying a house. If you were to work out what is the replacement cost of this house, then you start looking at, if I was to dismantle this house, construct a new house all over again in the same location, of the same quality, of the same design, how much is it going to cost me? Of course, when you dismantle the existing house, you're also going to get some debris which can be sold out for some scrap value. That credit you will take. You will reduce your cost to rebuild to the extent of the debris sale, the money that you will be able to realize by selling those debris. But that's how the replacement cost is worked out. Very useful in the case of M&A decisions. Every company looks for growth, and there are two different alternatives for a company to grow. Either you can go for a greenfield project or a brownfield project. Either a company can grow inorganically or organically. Organically from within. That means the company might decide to put up another manufacturing facility by purchasing a piece of industrial plot, by putting up a factory over there, by installing machinery, and the project is about 100 crores and it's going to take around 18 months time to get commercially operating. What is the alternate available to the company? You can look for an existing running company to acquire. The entire deal can be negotiated within a period of just about 3-4 months time, and you can have that ownership of that new business within a period of about 5 months, 6 months time. But the cost that you would be ending up paying would be about 130 crores. Now that's a CBA, cost benefit analysis. Setting up your own plant, the cost is going to be just about 100 crores, but the time involved, 18-20 months. If you go for M&A, the cost is going to be 130 crores, but the company is going to be yours within 5 months. So this is 13-14 months of time versus 30 crores additional that the company is going to pay. You have to have a cost benefit analysis with a view to arriving at a decision whether the company should go in for a greenfield project or a brownfield. So essentially, there are three approaches to valuation of any kind of companies, including companies in the maturity phase. You have income method, you have market approach, and you have cost-based approach. Sometimes you apply all the three approaches together and then look at what is the range of values that you are getting. And probably then, in that case, you might decide to use some kind of an average value, either a simple average or a weighted average to arrive at the final value of the corporate entity. At times, we might just use two approaches. At times, depending upon the situation, we might just use one particular approach and arrive at the value of a particular. Of course, COVID has hugely impacted the valuation of various businesses. And some people in the marketplace are asking questions. How should I do valuation in this area or in this arena of COVID? But valuation guru Ashwath Damodaran says, don't abandon valuation fundamentals even during the COVID-19 crisis. You should stick to the basics. It is precisely times like these that the basics matter the most. And Ashwath Damodaran says, you need to go back to the first principles of valuation. Stick to the basic principles of valuation. But then, as we have market premium, as we have market discount, as we have control premium, as we have control discount, there is a new premium and discount which is being used today while carrying out valuation, and that's called COVID premium, COVID discount. All of us are aware how to carry out valuation. We use control premium in some cases. We charge control discount at some cases. Another discount and premium concept has come into the market now, and that's COVID premium for the companies or sectors which have been benefited by the COVID-19 pandemic, and a COVID discount for those companies or sectors which have been negatively impacted by the COVID-19 pandemic situation. So a new concept of COVID premium and COVID discount has become applicable in today's marketplace. Every company passes through a life cycle, and valuation is required to be carried out at various life cycles of a company. A good valuation is a bridge between story and numbers, because all numbers have a story and all stories need a number. depending upon a company's life cycle age, the valuation of that company also changes, and either the number or the story carries greater weight. Ultimately, it's a bridge between stories and numbers. A company has a life cycle. Value of the company will differ from each particular phase of the life cycle. It keeps on changing depending upon the changes in the life cycle of the company. The valuation will change either in terms of numbers or in terms of story, but nonetheless, story and numbers both go hand in hand together in the valuation of a company. What happens when the company is in the startup to decline? Let's focus on the maturity stage. When the company is in the maturity stage, your revenue is very, very high. In fact, at the highest peak. But the point to note is it's not rising any further. The company would reach some kind of a plateau. It's a flat curve up there at the maturity level. Even though you are reaching the peak, you have reached at the peak, but the sales are not growing any further. There is kind of a plateau that you will have. But the revenues very, very high. What is the position of cash? Cash also relatively very, very high at the maturity stage. Profit also very, very high because your business is mature enough. Because your business has come out of the shakeout stage. You have had growth, you have had pangs of growth, you have had a shakeout stage, and now you're in maturity, at which level revenue, cash, and profits, all three are very, very healthy. Same stuff, profit and sales, introduction, growth, maturity, decline. So what are the characteristics of businesses which are in the maturity stage? Because basic concept, process, and principles of valuation will remain the same, whether you are valuing a startup or a company in growth phase or maturity phase. But the kind of adjustments which will require to be carried out while valuing a company in the maturity phase will depend upon the specific peculiar characteristics of a company in the maturity phase. That's what precisely has to be properly understood with a view to arriving at an appropriate valuation of a company in the maturity. When the business matures, sales begin to decrease slowly because which is the next phase? That's a decline. Profit margins get thinner. Cash flow stays relatively stagnant. As firms approach maturity, major capital spending is largely behind the business. The company has incurred huge capex in the past, but the company probably is not looking for much of a new investment. All your cash generation, all your revenue generation is happening and is a result of major capex spending that the company had in the past. And therefore, cash generation is higher than the profit on the income statement. Cash generation, revenue is higher than the profit in the income statement. Mature companies have a strong market share. That's how they have reached out and they have gone across the breakout stage. They have a strong market share. They have a very strong customer loyalty. They have a strong market presence. And that would have been possible only on account of an attractive, robust, and resilient business model. Attractive, robust, resilient business model. Consumers would not go as aggressively as an industry in early stages. Your sales have reached a phase which is kind of a plateau. Now the customers won't grow. Now the sales revenue won't grow much as it happened in the earlier stages. What you got to do is, if you are looking for extending your business life cycle, if you want to extend your life and staying in a maturity phase before getting into a decline phase, this is what I was talking about. Philip Kotler talks about this concept as second hump. You try to once again give some kind of push to your business that instead of getting into a decline phase, you somehow try to propel your business for a second hump. trying to reach on to a different business cycle altogether instead of getting into a decline phase at this point of time. And that is possible if you reinvent yourself and also invest in new technologies and emerging markets. This is an important point to be considered while valuing a company in the maturity phase. You got to look at what is the company's model, what is the management thinking. Are they looking for the ultimate? Are they looking for ultimate decline? Or the company is aggressive and they're optimistic. They're trying to reinvent. They're trying to invest in new technologies, and that probably will give an entirely different valuation to a company in the growth phase, depending upon what is the stance of the market. Are they taking it that, oh, we are in the maturity phase now, and next it's going to decline only, we just can't help? Or the company is taking a stance, we want to extend the business life cycle phase, we want to have a second hump, we are prepared to make fresh investment, we are prepared to reinvent ourselves. That will give you a different valuation for the company altogether. Mature companies deliver most of the current output of GDP and employment in an economy. But most of the revenue of the company in the maturity phase is arrived at from the value of existing investment. A mature company is one with a strong customer base. Typically, it would have reached the maximum amount of people, maximum number of people that it could possibly reach. Thus, for a mature company to improve profits, it may not be possible to increase the number of customers. If you want to still improve your profit, that would be possible only by improving operational efficiency, decrease costs, or expand your business through capex. That's the only thing possible. You are not able to add new customers. That's not the way to increase your sales now. That's not how the company can generate higher profit. The only way available for the company is to improve operational efficiencies, decrease costs, or increase your business, expand your business by fresh capex. Companies in maturity phase tend to have a lower PE ratio, price to earnings ratio. High dividend yields are also an attribute for companies in maturity phase. Mature companies have excess inventory and working capital as they adjust from the previous stages in the industry life cycle. Breakout stage, where it was very, very promising, very rosy, very optimistic picture. And in view of that kind of scenario, the company carried huge inventory, huge working capital, and which still remains to a certain extent, even in the maturity phase, because it takes time to adjust to the levels which are required in the current phase. Revenue growth becomes steady. Profit margins, they follow a pattern, making it easier to forecast earnings and cash flows. This is another important point for valuation perspective. Revenue growth is steady. Profit margins have settled into a pattern, and thus it is easier for the purpose of valuation to forecast earnings and cash flow. Since there are no capital investments to be made, the company doesn't require holding of any cash. So whatever distributable profit the company generates, there is a high payout on account of dividend, massive cash flow to equity. High dividend payments are normally the norm in case of mature companies because you have no plans for fresh capex, but you are still generating a huge amount of cash. So according to basic dividend theory, you should pay higher amount of dividend to the shareholders in case you don't have a good or a profitable use of the cash. In case the company has profitable use of cash, then of course you can curtail and you should curtail the payment of dividend to the shareholder. Mature firms are more likely to look to financial restructuring to increase their value. You tend to change your capital structure, debt equity structure, with a view to trying to reduce your WACC to the extent possible. with trying to reduce your accounts receivable to the extent possible. Market value of product tends to decrease with new competition in this phase. Maturity stage gives the company the momentum to sell its products and goods. There is a high brand and product awareness. This is the stage where a company can maximize its sales and profits with limited investments and marketing costs. That's another important consideration from valuation point of view. Your marketing costs will be very, very low at this level. You don't need to spend much on marketing. People already know about your product. They are already loyal to your product and services. You need not incur very high marketing expenditure either for advertising or sales promotion or anything of that sort in the stage of maturity. Over a long period of time in maturity stage, what is the next phase? The product value or the perceived value, it starts diminishing. The marketing challenge at that point of time is to increase the sales out of potential customers who are now being allured by reduced prices of the competitors' brands. How do you get that second hump? It might require some additional capex. It might also require huge juggling around with your marketing strategies. How to ensure that your customers don't immediately walk away to the customer or a competitor who is offering lower prices for a particular product. So, companies in the maturity stage obtain their cash flows from existing assets. Valuing these assets become more critical than it was at the earlier stages, and it includes consideration of the following issues as outlined by Ashwath Damodaran in one of his books. Estimating free cash flow is embedded in how such companies have used accounting rules to manage earnings and how they have covered management inefficiencies accumulated in recent years, resulting in biased returns. Very important. Please read again. How companies have used accounting rules to manage earnings and how they have covered management inefficiencies accumulated in recent years, resulting in biased returns. If employees of the company have been given ESOPs, top management of the company enjoys employee stock option plans, they have an incentive of manipulating accounting numbers because their bonus, their incentive, their ESOP, they depend on the numbers. They have an incentive. I'm not saying they do it always or all of them do it like that, but there's always going to be a chance. So you have to keep a keen eye while you're looking at data. While you look at normalized data, you must have a keen eye and be able to find out, are there some management inefficiencies hidden behind these numbers? Are the returns which are being shown in the last 5 years, are they real returns or biased returns? Very important consideration from valuation perspective while valuing a firm in maturity. In addition, revenue growth rate of mature companies can diverge from their earnings growth rate due to improvements in operational efficiency and cost reduction. Therefore, in-depth analysis of accounting results is necessary. What we are saying here is revenue growth rate of mature companies can be different from earnings growth rate. Sales and profit, how do they match? The companies may not have a fairly stable PV ratio, profit volume ratio. It might differ depending upon operational efficiencies and cost reduction. Therefore, you have to carry out in-depth analysis of accounting data. Mature companies will be more focused on external growth than on organic growth because they know this is the life cycle. After having reached a plateau or the maturity phase, the ultimate phase is that of decline. You can try to breathe some time, you can try to get some more time. Instead of getting into decline 2 years later, you might go into decline 5 years later, try to get a second hump, but end of the day, it's a life cycle. You have to think of something else. So they'll be more focused on external growth. that is going for mergers acquisition, making investments, because if they want to sustain their business on a going concern basis, that's the only alternative available to them. Accordingly, Damodaran says the two main elements required for a correct estimation of FCF at this stage are valuing the growth from acquisitions. If the company decides to acquire companies, they have a well laid down blueprint and a plan for acquiring companies for maintaining their growth. How do we value that growth? And secondly, assessing the impact of changes in the way a mature company is run. That means how the company is going to run in future. I mean, it can be similarity can be drawn by our own lifestyle. How do we live our life when we are young? How do we live our life between 30-50 or 30-60? How do we live our life between 60 and 80? What happens after 80? I mean, you have to change the way you run your life, you manage your life. Similar is the case with companies. As they age, as they reach from one phase to another phase, they also got to change the way the companies are operated in the real sense. Even for companies in the mature stage of their life cycle, it's a jungle out there. Apart from constant fight to maintain their competitive territory, mature companies often hunt for attractive targets, M&A targets, either to grow or to eliminate competition or avoid being acquired themselves. There are three objectives of M&A in the case of mature companies, either to grow or to eliminate competition or avoid being acquired, avoid being taken over by some other company. You have a lot of cash available with you in the maturity stage. So this is another way to utilize excess cash flow. However, the return on equity being provided to stakeholders may be very close to their expected required rate of return. Therefore, there are no abnormal returns being made at this stage. Changes in operating efficiency can have a large impact on earnings and cash flows. Mature firms turn to acquisitions to recreate growth potential. Predicting the magnitude and consequences of acquisition is though very difficult than estimating organic growth through internal investments. So Damodaran says a company can either try to propel their life cycle phase by a few years by making internal investment, or they can go for acquisition of businesses outside externally. Out of the two, it is easier to work out the value of internal investments rather than able to value the external acquisition value that the company will generate by way of mergers and acquisition. Sometimes a very interesting question which is faced by the valuation experts for the companies in maturity phase: is maturity a threat or an advantage? It's a point of inflection. It's a very, very important point in the life cycle of a company. It's a stage in which figures have gotten to the top, and everyone knows after that what will happen. The figures will start decreasing. One of the biggest dangers in this phase is not recognizing it, not recognizing that you are getting old. You still behave, you still run your life, you still maintain your life as if you are 40 years. Baba, you are now 60 years old. So you got to change the way you live your life, but not recognizing is one of the biggest dangers. The real endangerment is to believe that numbers will regrow, that profit will be accomplished by performing the same practices. This will not happen. Owners, managers have to acknowledge differentiation is the key word in the maturity phase. Differentiation. Today, diversity is very important for winning a customer's preference. Acquiring their attention is the main issue, especially if they want to refresh for their activities in order to be able to regain their pace. Yes, maturity is also an advantage. Refreshing is possible. While competition may be delivering a cheaper product, expertise of the existing company, old company, may give the company opportunity to sell at a better price or offer better after sales service. A mature company would be able to exploit its reputation in order to tell the customers they are in good hands. In maturity phase, reputation may be used as a competitive advantage. Of course, the company has been there for quite a few years. You build a solid customer base in the marketplace, and that's what you can play around with now. Maturity phase for a company is both an advantage as well as a threat. Maturity can be a threat if the managers are not humble enough to understand as to what's happening around them. They somehow tend to believe product will do the magic all by itself. There is a big market. There is a big market pie. There's place for everyone in this market. Yes, true. But complexity of the market may prove that if figures are not growing, time has come for you to change. It's a company's choice and its board of management to decide whether maturity is an advantage or a threat. And based upon that, you will decide the discount premium or the discount factor discount that you will apply while carrying out valuation of a maturity phase. What is the outlook of the management? Are they looking at as an advantage? Are they looking at as a threat? And accordingly, you will either charge premium while carrying out valuation or you will apply a discount to adjust the normalize the valuation that you arrive at. This is same which I have already explained. So maturity is a mixed blessing. Even the best of the growth companies reach a point when size works against them. We are all familiar with the concept of economies of scale, but beyond a particular level, it becomes a case of diseconomies of scale. The mix of debt and equity may change overnight. So, not surprisingly, mature firms usually are targeted in hostile acquisitions and leverage buyout (LBO), where the buyer believes that changing how the firm is run can result in significant increase in value. Mature firms are huge M&A targets because the buyer believes that the way the company is run, I can run it better. I mean, the basic philosophy underlying there is I can do it better. The company has a great market. The company has a great product. They're not able to run it well. I can do it better. And that's why most of the mature companies they become a target, very attractive target for M&A. So in general, it is easier to value mature companies than high growth companies because of the availability of relevant historical data on earnings, cash flows, and revenue. However, that doesn't mean that there are no challenges in valuation of mature companies. The biggest challenge is complacency. Taking for granted that mature companies have consistent results that can be comfortably projected into future. That might not happen. That may not be possible. Valuing companies in a mature industry generally follow the traditional valuation methodologies using DCF, precedent analysis, comparable company analysis, sum of the parts, and leverage buyout analysis. Because companies in a mature phase tend to have a stable and a consistent cash flow, a discounted cash flow analysis should give good intrinsic valuation of a company. A precedent transaction analysis will give the upper bound of a valuation range for a company in a manufacturing phase. A comparable company analysis will typically give a valuation close to the intrinsic value of a company. Leverage buyout analysis will provide a lower range value for a company in maturity phase. Sum of the parts analysis with many different business components valued separately provides you a very useful information about the overall aggregate value of the company. We are all quite familiar with this. We teach valuation day in and day out to our students. This is how a spreadsheet looks like when you work out a DCF model. What is the tax rate? What is the discount rate? What is the perpetual growth rate? What is the EBITDA DA model? What is the current price? What is the shares outstanding? And then you have revenue, and then we deduct expenses out of that, and then you get EBIT. From EBIT, deduct cash taxes. You have no PAT. You add depreciation and amortization. Then you deduct capex out of that. Also deduct net working capital, and then you have unlevered FCF. And then you can work out FCF by using either the market value concept or the DCF value, that's the equity share value concept. So in maturity phase, the opportunities for a company to grow are limited. And most often in the marketplace, consolidation takes place through mergers and acquisition activity. At this stage, most of the firms experience thin margins of profit. However, profits are stable and they keep on flowing year after year in a predictable manner. Although, because of stability of the business in the mature phase, estimation becomes simpler. But analyst has to be careful to consider potential problems. To conclude, the basic principles and approaches to valuation remain the same for mature companies as well. However, their application needs to be artfully played around in view of the special and distinct attributes of companies in maturity phase. We should also be looking at emerging dimensions of valuation, profit, not only profit, impact of the company on people, society, impact of the company on planet, environment, and impact of the pandemic on the company. This we discussed yesterday also. We also got to look at different types of capital and their contribution in the company, not only financial capital, but other 5 different types of capital also, as initiated by International Integrated Reporting Council, IIRC. There are certain misconceptions about valuation. Some people believe a valuation is an objective search for true value. That's not true. Actually, all valuations are biased. Yes, believe me, all valuations are biased. The only question is how much and in which direction. That's because it's more of an art rather than a science. That's because valuation involves judgment, valuation involves hunch, and therefore we cannot have something of a true value. All valuations are biased. Second myth is a good valuation provides a precise estimate of value. You can clearly work out the value of a company, 176 crore, 5, 176.5. No, it's not possible. There are no precise valuations. At best, you can work out a range. Most likely, the range of value of this company is going to lie between 160 to 180 crores, but it cannot pinpoint one single number. That's going to be very difficult practically. And there are all kinds of software tools available in the marketplace for data analysis, starting with simple spreadsheet to Python to RStudio and whatnot. And some people believe the more quantitative a model, the better the valuation. But the fact of life is simpler valuation models do much better than complex ones. Because it is GIGO, garbage in, garbage out. All those complex software packages, they require a lot of inputs. And in case all this information is not available or the information is not reliable, the output that you get, the result that you get is also going to be to that extent not acceptable. Who is a cynic? A man who knows the price of everything but the value of nothing. End of the day, valuation is all about trying to understand the basic equation. Price must always commensurate with the value. That's where both the parties, the seller and the buyer, are going to be happy ever after. If there is not comparison or if they are not commensurate with one another, one of the parties is going to repent later on. But most of the people, they know the price of a product, but they don't know what value they're getting out of it. That's where I close my session. Thank you very much. I'll be pleased to take a few questions if there are any.
Okay, thank you, sir.
Thank you.
Thank you. It was again a very engrossing session, something
Thank
which
you,
is
sir. Thank you.
interesting. So now the audience, the participants, if you have any query which you can ask, short questions which you can ask Dr. Gupta, you can go ahead.
Yes,
Otherwise,
please.
I will share his email ID with you so
Yeah,
that
yeah,
if you
sure.
have any detailed query, if you want to approach him, so that you can
Anytime, anytime,
end up with
anytime,
him.
any one of you can approach me. I'll write my email ID on the chat box also for all of you to get
Okay, sir.
get connected with me.
Sir, Dr. Dipesh Mahajan is raising
Yes,
his hand and
yes.
just allowing him to raise the question.
Good afternoon, sir. Again,
Good
a very
afternoon, Ji. Yes,
again
sir.
excellent
Thank
session
you.
from your side.
Thank you.
My few simple questions are there.
Ji.
Whenever we do valuations, do means we segregate our methodologies with reference to sectors or industries? Say, for example, if I am valuing a company like Gas Authority of India Limited, or I am valuing a Reliance Industries Limited for the for the purposes of valuation, so do I have to lay down different parameters for valuing them? Say, for example, means I am extending it. I know. Say, for example, Gas Authority is having huge reserves and Reliance is having relatively less reserves as compared to it. So, my valuation should have different parameters with reference to these companies.
Absolutely, sir. The basic approaches remain the same. You have the income approach, the market approach, and the cost approach. And cost approach is going to be more relevant in case of industries which have high level of investment.
Okay.
And the income approach is going to be relevant for companies which have a fairly highly stable or growing income level. If there is a
Okay.
company which has a very low level of income and it's also not growing, but probably it might be asset heavy, and then you have to follow the asset approach. And if there might be a company which has low level of asset, at the same time low level of income, but has a huge market share, then probably market approach might be more relevant. But in most of the cases, practically, all the three approaches are applicable to every company. Almost. That
Right.
happens 90% of the time. So you can use all the three approaches, try and work out the value, look at the range. What is the
Okay.
value that you are getting by applying all the three approaches? And then probably you can decide to go for either a simple average or a weighted average to finally arrive at your value.
Okay. Great,
That's
sir.
what it is. How
Can I
far?
ask one more question?
Yeah, sure, sir. Sure.
Sir, you cited an example of Zomato in the
Yeah,
last discussion
yeah.
and the present discussion as well. Fortunately, I also read the report of Mr.
G, G.
Damodaran before I was going for investment into that particular
I
IPO.
know, I know.
Sir, when we learned laurels like Damodaran sir or people like you can evaluate a company and say that the price is approximately 30 rupees. So how could SEBI allow these issues to be listed at so inflated prices and premium onto such pretty ordinary valuations which are visible over there and
No,
some other
SEBI
value?
has, yeah, SEBI has no control on the price band that the company fixes. It's entirely at the discretion of the company for
Market.
that matter. At best, what people are talking about in the marketplace now is that Paytm, they have lost a huge amount of money in the Paytm share. They're talking about something of a safety net, that
Yeah,
SEBI should come out with some kind of a safety net that
yeah,
in case they get fixed in a Paytm kind of a issue, how to wriggle them out.
right.
They are talking about the safety net, but otherwise, SEBI has no control on the price band. It's entirely market based. There
Yeah,
is an offer from the company to sell their shares. There are takers at that price. Nobody can help it. Whether
definitely,
it's a
yes, sir.
right decision, wrong decision, SEBI cannot enter into this war. It is only between investors and the company.
Got it, sir. Got it. Thank you
Thank
very
you.
much, sir. Thank you.
So can I
Thank you,
ask
sir.
a question?
Yes, ma'am.
Sir, what is your say about the share of Paytm? Like in if you talk about the valuation, recently Paytm also issued an
Yeah,
IPO,
that's what I'm
and
saying. It is quoted at 25% of its issue price. So
yeah,
probably investors made a mistake in reading through the story of Paytm. It's not only about numbers. Their financial position was much better than that of Zomato. But what they faltered on is that the issue price kept by the promoters was very, very high. Probably there was a mistake on the part of the merchant banker or the investment advisors which advise the management of the company to fix the price band. It's a good company. They have a good product. Everybody uses Paytm. Why not? And they have a lot of other companies in the group also. But the price that they fixed for IPO, that was found to be on a higher side. And the price is now stabilizing based upon the collective wisdom of the investor. It is now stabilizing around its intrinsic value or the basic value.
Yes, sir. But in this case, like layman investors like us, if suppose, a person who don't have much knowledge about the company's investment policies and everything,
I
so
know.
they are actually at a fix because they've invested a big amount and they do
Absolutely,
the major loss.
absolutely,
So
absolutely.
all our
They were
analysis
carried away
goes
by the
down.
hype. They were carried away by the hype because they don't have much of information, much of knowledge to evaluate a company. They were carried away by the hype.
So, sir, here where behavioral finance comes in, they are
Yeah,
affected
behavioral
by the herd
finance
Right.
is very
behavior.
important. Very
They are
important.
affected by the herd behavior.
Very important. Herd theory. Yeah.
Exactly. And a lay person should start studying finance like us, because
Yeah.
then they will become more
Very
knowledgeable to
important.
take.
Very important, sir.
And as I've seen, CBSE is now planning to incorporate financial studies, basic
Okay.
ideas
Right.
about finance, even at class 9, 10 level.
Oh, that would be great. Yeah,
Yeah,
yeah.
yeah,
That would
yeah.
be great.
They have
Finan-
already, sir, sorry
Financial
to pardon,
literacy is
but
there.
they have already added in the
Exactly.
syllabus. There is a subject of
Oh,
financial
Exactly.
management
okay.
in
Financial
the syllabus.
literacy is there.
Yeah,
So
the basic
this
understanding
will,
of finance.
yeah,
G,
I
G.
guess things will improve in the future market,
Yeah.
Indian market. Yeah. Sir, if I may add, with respect to the methods that you said, relative valuation becomes the appropriate method in the absence of information
Absolutely.
of the
Absolutely.
target firm. I may say that.
Absolutely. Absolutely, sir.
Yeah.
Relative valuation is very useful. Very useful
Yeah.
approach to follow.
So that is mostly for the closely held companies. Can we say that?
Yeah, yeah, that's right. That's right. Mostly for
Yeah.
the closely held companies. Sure.
Whose data are not available, publicly available.
G, G.
Okay. Yeah. Dr. Ravi, do you
Yeah.
have a question?
Yes. Dr. Gupta, it was a very good
Thank you, sir. Thank
presentation
you, sir.
yesterday and today. I can relate this valuation with the acquisition of Air India by Tata.
Yeah, yeah.
Air India is in loss. Everybody is telling 70,000 crores loss, right?
Mm.
But Air India has got a lot of rights to land at the US and UK airports.
That's a
What
huge
we call as
advantage. Yeah.
what we call as a slots, yeah,
Yeah,
the
yeah.
airline
That's a
slots.
huge advantage.
Huge one, yeah.
That's right.
So valuation, like what you said, is it could be an intangible one, which cannot be really, put it in some kind of money
Numbers,
value,
yeah.
yeah, numbers. But certainly competitively, they will have definitely a better edge over other companies.
Absolutely,
So
absolutely.
yeah,
The
just I want
reserve
to add
price
to
in
that.
case of
Yeah.
Air India, the reserve price was fixed at 12,000 crores.
Yes.
Finally, Tata's got it at 18,000 crores.
Yeah.
Out of which they have taken 2,700 odd crores of debt out of
Correct.
70,000 crores, and
Correct.
rest is equity.
Yeah.
That's the basic structure of the Air India deal.
Yeah. Thank you very much.
Thank you, sir.
So other participants, sir, I can see a student participant. He has
Yeah,
raised a
sure.
that, sir, how can we differ between a mature company and a high growth company?
Mature company and high growth company, these are similar terms being used. Even if you Google out, you'll find out both the terms are being used similarly. High growth company could be in the breakout phase. It may be just about to enter into the maturity phase. But the maturity phase means the sales have become stable and they're at a plateau. Whereas the high growth company may, at this point of time, be showing signs of rising sales even now. So this is just a split stage behind the maturity stage, but it is sort of intermingling with the maturity stage going forward. So not much of a difference, but there could be a difference in case of a particular case where the high growth company might still be in the growth range, whereas maturity company is one where it reaches sales at a plateau.
So, sir, to add to it, for valuation exercise, the cost of capital of these two the WACC will definitely differ.
Will differ, sir. Definitely will differ. Yeah.
So, other participants, we have just a few minutes left. If we can entertain one more question, a last question. So, if there are no more questions, then we can
Thank you,
end
sir.
this
Thank
session.
you. Thank you.
And I would, as always, say the session is ending, but the thought has
Yeah,
process has
that's right.
begun.
That's right. That's
So
right.
our homeworks have begun.